Hello, I'm Gary Stringer, Senior Portfolio Manager at Shelton Capital Management. Welcome and thank you for joining us for our June 2026 Review and Outlook presentation. Now, regardless if you're watching this video or listening to the audio podcast, we thank you for your time and we appreciate your interest. In this presentation, we provide a brief summary and an explanation of our current economic and market outlook. For more details, please contact your financial advisor, and thank you again for joining us. So our theme for June 2026 is Despite Uncertainty, the U.S. economy powers on. Now, looking at the broad outlook, economic fundamentals in the U.S. have actually improved despite volatile headlines. And we can see this in expectations for faster economic growth during the second quarter, and as well as recent stronger jobs growth. The U.S. infrastructure build out featuring AI, but also impacting manufacturing and energy supports economic activity now and into the future. We remain overweight U.S. equities, emphasizing financials and industrials as well as information technology. Within fixed income, we favor high-quality asset-backed and mortgage-backed securities while taking less interest rate risk than, say, the broad fixed income market. And we continue to utilize alternative investments to emphasize assets that can generate current income and offset inflationary pressure while also offering a correlation benefit. So there's a lot of opportunity out there to help investors navigate these challenging markets. So let's look at GDP growth expectations for the second quarter. Here we're looking at this bar chart showing the first quarter grew at 1.6% annualized. The New York Fed's nowcast is estimating about 2.7%, while the Atlanta Fed is estimating over 3% growth for the second quarter. So though we've seen significant economic headwinds and challenges coming from what's happening in the Middle East and other areas, the underlying economy is actually accelerating the pace of growth. We can see that also in the monthly jobs creation numbers. Now, again, if you've seen this before, we track the monthly numbers as well as the previous business cycle to see how we're looking compared to that. And we look at a moving average, so it's roughly 6-month moving average typically, and that helps us smooth out the volatility from the month-to-month noise. And what we can see here is recent big jump, not only in last month and the prior 2 months, where we've seen upward revisions to jobs creation. So the 6-month moving average went from around 0 in terms of job growth. Has actually been picking up. Though we're still below the average from the previous business cycle, things are moving in the right direction, in a positive direction. Now, the infrastructure build out. Here we're looking at private, non-residential fixed investment. So that's a fancy economic term for businesses investing in their own businesses, right? So this isn't government spending. This isn't household. This is specifically around the business sector. And what we can see here is the infrastructure build out is having a significant impact on economic growth. Here we're looking at investments in structures and as well as research and development. They've been growing for years. And this immense spending, so it's not just a recent phenomenon, it's actually picked up several years ago, but it's accelerating. But this immense spending is having positive impacts on the real physical economy. And so we're seeing that in more factories and so forth, as well as the data centers. There's a lot of build out in the industrial capacity, broadly speaking, in the U.S. And that will benefit us, we think, for years to come. So the investment implications. Our strategies remain tilted in favor of the U.S. At the sector level, I mentioned financials, specifically regional banks, industrials and information technology. In the fixed income space, we like mortgage-backed and asset-backed securities for their current income and a favorable risk reward profile. With respect to the alternative allocations, which are a meaningful part of our portfolios, equity option overlay strategies generate current income, and the multi-asset real return strategies lower a risk of inflation impact and offer low correlated total returns. So this positioning is designed to be resilient across a broad spectrum of potential economic outcomes. But of course, we are, as I mentioned, pretty optimistic about the U.S. economy. So we think that when we can see volatility, it's probably a buying opportunity. And here's another way to look at it: industrials, regional banks, technologies, as well as a multi-sector real return. Now, the cash indicator. The cash indicator has held steady at levels below the historical norm, but higher than they were when the markets, we think, were overly complacent. In fact, what we see here is a lot of the fixed income market continues to reflect confidence in the economy and financial markets despite bouts of equity market volatility. Overall, the recent volatility we've been experiencing is really a healthy reset for expectations. And we see a healthy amount of skepticism actually in the equity market, which we think is good for positioning a long term. So while the cash indicator has elevated from its lows months ago, it's nowhere near a level where we'd be nervous and thinking about raising cash. I will thank you for your time. And again, if there's any other questions you might have or anything we do to help, please contact your financial advisor. They'll be happy to support you.